Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night to answer your questions in an attempt to try to make sense of markets that really don't make any sense. And how can they when in the midst of some of the worst news in history, like today we got the Dallas Fed Manufacturing Outlook Survey, worst print in the history of the index, worse than it was at the worst point in the great financial crisis, and yet stock prices go up. In Texas, that index suggests there's going to be massive amounts of layoffs in the oil industry that were already coming to begin with. Now they're only going to get worse. And so stock prices go up, and people think this has got to be a bottom. And yet all those people in Texas, not to mention other parts of this country that are tied to the energy sector, primarily to the oil sector, directly and indirectly, are going to lose their jobs soon. And everyone's focused on this has got to be the bottom. It's not even close. I'll give you some more evidence of that. And then what do we see today in the bond market? We saw yields go down in overnight trading. It is important to understand that the yields, hold on, wait, yes, we need the arrows. I forgot, how can I ever do a video without arrows? That yes, when stock prices go up, because everyone loves stocks, will make them green, that yields, Treasury yields, they have to go up too. So what did we see today? We saw stock prices go up, and overnight we saw yields go down, and then we saw investors fight and kind of push them up a little bit because yields have to validate rising stock prices. And if they don't, stock prices are going to go down. That's what happens. That's how the system works. And I tell you, it took me a long time to come to this conclusion. But when you see it and you understand it, you're really empowered. And of course, that's why you listen, because I tell you how the system really works. And I don't just tell it to you, I show you, back it up with hard evidence. And let's get right into your questions. I got a ton of great questions over the weekend and today, so let's hit them. First, what happens to a bond-based retirement plan, e.g. the F fund and the federal thrift savings plan, TSP, once Treasury yields reach zero? Well, what would happen in this case is the price appreciation is probably pretty much done. In fact, I would assume that they would actually go down in value as the smart money looks to liquidate their bond positions, the retail investors come in and then realize they're on the wrong side of the fence and then sell. Let's go on with this question. Once yields reach zero or negative, will they continue to increase in value? No, I don't think they will. I'm guessing the answer is yes, as people will buy bond-based shares as they continue to move from their equity holdings, only in the short term. So it'll be very short-lived. You look at the charts and they're very, very short moves. You're talking, matter of weeks, couple of weeks, and then you'll see the reversal as people now realize they're sitting on a negative yielding fund, and they'd rather at that point probably just be in cash. Of course, what they don't realize is cash is really 90-day T-bills, which are negative right now. But that's another story. Okay, on to the next question. Do you think leverage and inverse ETFs are okay for a retail investor? Absolutely not. But for those of you who do not know what they are, a leveraged ETF is something that gives you 2 to usually 3 times the upside, but 2 to 3 times the downside. So let's say you're betting on the S&P 500 and you're in a triple leveraged long ETF on the SPY, right? Symbol SPY, but it's not the actual symbol of the leveraged ETF. So let's say you're leveraged 3 times. In an overnight trading, you get a limit down of minus 5% on the indexes. When you wake up in the morning, you're down 15%. So you triple your fund on the way up, you triple your losses on the way down. And an inverse fund kind of does exactly what you'd think it does. If the S&P goes, say, up 1%, it's supposed to go down 1%. If the S&P goes down 1%, the inverse fund is supposed to go up. Unfortunately, inverse funds are not perfectly inverse due to the costs in the futures contracts to run them. They do degrade over time, which is why they're not perfectly inverse. So the question is, are they okay for a retail investor? No, no. These are not even okay for professional investors. Why do these things exist? They exist for one reason and one reason only, and that is to hedge positions. Could be during the day, could be for a couple of days. They're not intended to be long-term positions. And they really shouldn't even be available to the investing public, but they are. And so that's why they're out there. Should you use them? No. If you're synced up with the mechanics of the market, well, good luck, because the market's job is to make the largest number of fools possible at any given time. So just when you think you're right, you're wrong. And it's really hard to think you're right all the time. Now, I'm going to answer this person's second question, and I'm going to answer it in the absolute factual way I would as a professional, even though some of you might think, well, is that a sarcastic answer? No, I'm actually going to give you the straight on answer and mean it. So let me read you how he followed up. So for example, it's clear to me that we've only tested the first bottom. I would agree with that, if not more to come. So I'll hold my inverse ETF. So what he's saying is, or she, obviously I don't list names here and I don't want anyone to have their identity uncovered. So we'll say this person is currently short the market when stocks are going up. Means they're losing money. That's how it works. Okay, so I'll hold my inverse ETFs and sell them to the next. Sell them to the next bottom. Meanwhile, as the levered ETFs go down in price, I'll buy them cheap and sell them into the pops. So what he's saying, or she's saying, is I can time the market. Is I'm going to be able to catch the downswings and be short and make a profit. And then when that, I'm going to be able to flip and go maybe double or triple long and make a bunch of money. Okay, that's what this person's trying to suggest. And I'm not saying they can't do it, okay? I'm just saying it's darn near impossible. Let's go on. In parallel, acquiring cheap stocks that pay attention to fundamentals. Nothing's paying attention to fundamentals right now. Cash-laden balance sheets. Sometimes. Okay, so here's the answer. I'm going to give this person the legitimately straight answer I can. And some of you might think that I'm blowing smoke. I'm not. If you think you can do this, and you can do it, and you can prove it, you have a future being a hedge fund trader. Seriously. Because bear markets are the absolute hardest markets to trade, period. There's a reason they're called bear markets. There's a reason people lose all their money in these things. But if you have, maybe you have that magic. Maybe you have the touch, the feeling, the mojo. I don't know. Maybe you do. There are a few people in this industry that can somehow read the tea leaves and pull this off. If you can, I don't know what you do for a living now, but you should think about, if you pull it off, switching, because it's pretty much impossible. Seriously. I mean, trying to do what you're trying to do is really hard. Odds are you'd be on the wrong side of the market. I mean, look at today. The S&P was up over 3%. So if you're inverse or short against the S&P, you just lost 3% today. It's hard to do. A lot of hedge funds wish they had this kind of talent that could pull this off, because virtually nobody in the market does. But bear markets are weird. If you know the recipe and you get it right, you can make a lot of money. You get it wrong, like most people, you lose a lot of money. But no, you shouldn't play with these things. I don't. I wouldn't. And I mean, let's just put it this way. My insurance as an advisor that covers what I do for my clients, the positions I take, specifically says you cannot use inverse or leveraged funds. And I know my compliance officer's listening to this, and he's like, if I ever see you do that, you're gone. That's how it works. So in all seriousness, if you can pull it off, track your stuff. You've got a job in this industry at a level much higher than I do. If not, be very careful, because these things are rapid ways to lose your money. Like I said, you're triple long the market and it goes down 5% in overnight trading. Instead of being up or even, you're now down, starting your day down 15%. Yeah, so it takes a lot of stress to do that. Does the Fed release its QE repurchasing calendar ahead of schedule? About 2 days, each week, about 2 days. Although lately I've seen the mortgage-backed securities being posted about a week ahead. Is information released in the Bloomberg After Hours report yesterday to reduce from $75 billion to $60 billion per day over the course of next week? New information? Yes, it is. So the Fed announced they're going to back off some of their Treasury bill, note, and bond purchases from $75 billion to $60 billion per day. Now, keep in mind, at the height of QE 1, 2, and 3, they did that much in a month. Crazy. So again, this is new information. Yes, it is. Is it substantial change? No. Okay, would this be in an effort to slow the rate of decline in rates? No, I don't think so. So the reason I think it is they already have driven 90-day T-bill rates negative. Now, I don't know if they're still negative after today's close, but they're pretty much at zero. So in terms of the Fed's view, hey, mission accomplished. Why do we need to keep buying more of these when we already got them negative? I mean, that's what their objective was. So I think they're backing off a little bit because they don't need to buy as many T-bills. Now, they're still buying notes and bonds, and they're still buying bills, just not as many bills. My summation from learned is this will not change the trajectory for bonds, but could alter the timeline. It doesn't change the trajectory for bonds, and I don't think it has a material impact on the timeline at all. I mean, between their Treasury purchases and the mortgage-backed purchases, the Fed's buying $100 billion a day. Given there's 20 trading days in a month, that's $2 trillion a month. I mean, that far eclipses anything they've done in history. You know, so $2 trillion, $2 trillion, $2 trillion. I mean, it's just doesn't change my timeline. I mean, if it did, it's changing a smidge, not enough to matter. With the yields dropping and a deflationary period entering, what happens to home values? They go down. Assuming home values drop, what will happen to the value when inflation occurs? So normally people are going to think, okay, well, home values are going to drop. I'll enter the market later, and the price will go up, which is normally what you would want to happen, what you would expect to happen, except in about 6 months' time from now, 5 to 6 months, assuming the Fed continues buying $2 trillion of Treasury securities and mortgage-backed securities, inflation in this country will be dead. We will not have inflation. It'll be dead. Money will enter the system and die before it can do anything. This is what if you've heard people say the Japanification of America, they've already gotten to this point. We're going to be there in about 6 months if the Fed continues at this pace. Now, as far as we know, they will. Of course, they're subject to change at any time, but they will kill inflation. That is the negative aspect of QE. In an attempt to create inflation, they have to kill it first. And then once they kill it, it will be permanently dead. So I don't know what happens to home prices. I'd have to go look and see what's going on in Japan, and I have not. I've tried to look at some of their data, but I don't read Japanese, so I don't know. If you could look that up and tell me, or know someone who can, there would be your answer. So I don't think we're going to see inflation. That may mean housing prices don't go up much. And let's dovetail this into the second question this person asked. I'm assuming that mortgage rates will increase with inflation. Yeah, so let's define inflation real quick. The proper term is an expansion of the money supply, which can only be done by banks. Banks are the only entity that can create money. So inflation often gets lumped in because the Fed likes to do it this way, is an increase in prices. So assuming mortgage rates will increase with lending demand, yes. My thought is one would want to buy as many homes with low rates during the deflationary period prior to the onset of inflation. Yeah, now we get into a demographic issue. And this is why I'm not super excited about, I mean, you could almost say even stocks down longer term. I think we're going to be in for, I'm sure there'll be a bottom, they'll come off of the bottom, and then, probably like we had in the mid-late 70s, early 80s, where they just go nowhere. And the reason, and I think that same is true for housing prices, is what you have is a demographic issue. You have, the baby boomers on one end of the bookshelf, and you have millennials on the other. And even though millennials are a slightly bigger generation, let's just, for simple math, say they're the same size. In the middle, you've got me, the Gen Xers, and let's take a look at the situation. Let's zoom out. So we believe there's going to be a severe market correction. Asset prices are going to come down. That's going to be stocks, cars, houses. Now, if you're a boomer and you're entering or in retirement, what is going to happen to your spending? It's going to stop because you're not going to have as much money. Your retirement accounts are going to be less. Your property values are going to be less. And what are you going to do with those second and third homes if you own them? You can sell them. You're going to sell them. Maybe your primary home and downsize, but you're going to sell your second and third homes to get rid of those extra costs that you now can't afford. Now, from the millennials, this generation has just not had huge interest in buying homes. Now, part of the reason is those of you who are millennials watching this, you already know that your wages from an inflation perspective are less than the boomers were when the boomers entered the workforce. And housing prices for the boomers were really cheap based on their wages compared to where they are with you. So what do I think needs to happen? The millennials not only have to, as a generation, just buy the normal homes that they would buy, but they've got to absorb all of the selling from the boomers who are going to want to get rid of those assets to free up cash to supplement what retirement they have left. And I've said, my wife knows this, she's listening. I said the problem is the millennials need to buy like 2 or 3 homes each. They need to buy 5 or 6 cars each, because the way our system works, especially in a debt-based economy, is it's almost like a pyramid. You need more people at the bottom to drive demand. So the question becomes is, if you're looking to buy property during the next recession, is who's going to buy it from you? This is a serious question, because we know the boomers are going to need to downsize at some point. Are the millennials going to, buy those golf course homes for $500,000-$600,000 or more that they're selling for today? I don't know. So far, that generation just hasn't shown it. Maybe that will change. Maybe when those homes are half price, they will. I don't know. But there will be a point where you have 2 roughly equally sized generations. Why do we need even more homes? There's this brief gap where we're now where we do need more homes, but there'll be a point where we don't. So yeah, I'm not long-term overly optimistic on the housing market, not super optimistic. And so would I personally be loading up on homes? And no, because I don't think there'll be demand for them. Would it be a good time to buy one if I needed one? Sure. Would I go buy 5 or 6 of them? No, because I don't know who I'm going to sell them to. You always got to ask yourself when you invest in something. Like one of my clients, he called me today. He's like, I finally understood what you meant by you wanted to own treasuries because you knew who you were going to sell them to. You already knew a long time ago you were going to sell them to the Fed. Yeah, indirectly I'm going to sell them to the Fed because the Fed's going to be buying so many of them. So anytime you make an investment, if you're going to go out and buy property, you need to know who you're going to rent it to, who you're going to sell it to. Same with any investment. Okay, so next question. Ex-Iran leader, I'm not going to say his name right, but I'll try. Ahmadinejad, maybe, said recently in a tweet, hundreds of billions of dollars were injected into U.S. businesses to counter the effects of the coronavirus. If the money came from taxation, then the Americans are paying from their pocket, but if it comes from the Federal Reserve, all nations are paying. Would you say this is true? If yes or no, could you explain why? Okay, so again, this is my opinion because I don't know contextually why he said this, but Americans are going to end up paying for this. In fact, money's just being borrowed from the global pool of dollars. The Federal Reserve is not directly creating this money. We don't know the schedule the Treasury is going to borrow the money. We do know they are going to. And so I think what he's saying is if the Federal Reserve is just directly printing this money and sending it to businesses and consumers, it would hyperinflate the dollar and pretty much ruin anyone who's got dollar-denominated debt, or the fact that the dollar is the global reserve currency and trade is conducted in that, and that would be true. So are Americans really paying for it? Well, no, anyone who lends the government money is technically going to pay for it, and then the Fed's going to monetize it, so there's no real creation of money coming out of that. So I will agree with, let's see, what part... if it comes from taxation, Americans are paying. So yeah, I mean, we do pay taxes. It's not coming from the Federal Reserve. So it's not going to hyperinflate the dollar. Does it mean is the dollar going to go up? Probably, but it's not going to hyperinflate it because the system is being maintained intact. Next question, where will the dollars come from to buy $2 trillion of fiscal stimulus the Treasury needs to issue T-bills for? I am asking since I've heard there is a liquidity crunch for the dollar already in the system. Will that lead to higher yields? It will lead to lower yields. So the more government debt you have, the lower yields go. In terms of dollar liquidity, yeah, it is a problem, and it should drive the dollar higher. I don't know why I didn't look at the dollar chart today, but I didn't. Anyways, what has to happen is effectively the U.S. Treasury will go out and borrow it from the pool of available dollars. So government debt has to be bought. And then what will happen is the Fed will come in and buy it directly from the large commercial banks. They're going to obviously be buying $60 billion a day of Treasury securities. So most of that's going to swap back to the Fed's hands. And then the money that the Fed is creating, which they're literally creating from thin air, that's literally a computer entry. They just go in there and make up dollars. They have that authority, and those dollars will get stuck into excess reserves at banks where they can't leave. They can be borrowed against or lent against from the bank's perspective, but that money gets stuck there. So hopefully that answers your questions. It will not lead to higher yields, will lead to lower yields. Oh, I meant to have this article loaded up. Steve, could you explain this article from today? I can. I believe this is from Friday. So let's go and say this was on Zero Hedge. In a study in development, dealers run out of securities to use in Fed repo operations. So what this means is all of a sudden the Fed's daily liquidity injections, there's no demand for. And so what was happening here is the Fed knows there's a dollar shortage, but remember, the Fed has a limited number of tools. This is like needing to take a Phillips screw out, and all you have is a flathead screwdriver. So you just take it in there and smash the thing in there and hope it works. That's what the Fed does. So there was a dollar liquidity problem. What did they do? They offered dollar loans in exchange for Treasury securities because they thought, hey, that didn't work before, but maybe it'll work this time. Yeah, I know, the Fed is that dumb. The problem is due to increased banking regulations, banks need more and more Treasury securities to hold as collateral. So guess what? They didn't really want to do it. They did it when they had to, and now they don't need to. So they're saying, look, we're not going to give up our collateral. We'll deal with the dollar problem elsewhere. The other reason we're seeing no demand here is the Fed's now just outright buying Treasury securities, which if you study the great financial crisis and you see this is an exact replay. The Fed did repo operations, and I said, in some prior video that will go until the Fed realizes they have to come back to QE, and then once they get QE rolling, the repo operations will disappear. So we're seeing demand for those go away, and if, at some point, as all of these repo loans come due, you'll just see that no one's interested in them because why would I lend you securities when I can just sell them to you? So that's kind of, whoops, what happened there. Let's get that out of the way. Hopefully that answers your question. So the next question is more of a comment. We're going to see supply shortages in a few weeks due to supply chain disruptions. Yes. Lower supply of products will result in higher prices. For some things, it will. Absolutely. But not for things like crude oil. So maybe, alcohol gel, yes. Crude oil, no. So it just depends. So there will be some disruptions. Some things will go in high, prices will go up, but many things prices will go down. Why will prices go down? Because businesses are desperate. Locally, this weekend, two of my favorite restaurants, BJ's Brew House. I don't know if it's, I think it's more of a West Coast chain. It could be wrong. And Jersey Mike's, which I know came from the East Coast, sandwich shop, they were both offering one was offering 50% off pizza. You can figure out which one that was. And the other one was offering 50% off sandwiches ordered through their app. That's not inflation. That's deflation. So, and even though there's allegedly problems in the food supply chain, apparently not with pizza or sandwiches this weekend. The Treasury will send out money to Americans. Unless the money can be spent in foreign countries, the increased money supply will result in higher prices. No. Treasury's borrowing money and giving to someone else. Think like Robinhood, right? Steal from the rich, give to the poor. So here's how the system works. The Treasury borrows from people with dollars and gives to people who perceive it needs them. No money's created. So no inflation. The Fed is not allowed to buy non-government-backed assets. Correct. However, the Fed seems to have circumvented this law. The Fed seems to circumvent things in whereas if you read deeply enough, you'll find out it's like literally like here's the law and they're like right up next to it. They'll create, special banking vehicles. They'll create loan programs where, yes, we're going to buy corporate bonds, but you have to pay the loan back, as collateral. You have to buy it back in 90 days. There is a stock purchase program that they did in exchange for cash, but there were loans, meaning the stock was just collateral. Don't worry, the Fed will skirt the law to the letter, but they won't break it, because if they break it, then that gives Congress the power to come in and dismantle the Fed. The Fed knows they want to dismantle them. They've known for years. It's nothing new. Congress would love to have the power of the Fed. They would love to be the ones that direct this. So don't worry. The Fed is using every ability in its power to make sure it stays within the laws, but to make you think they're cheating. They're not. They're just very, very crafty at it. Given these new Fed Treasury powers, are there specific institutions they can buy assets from that would result in getting new money into the domestic economy and result in higher prices? No, the Fed's got to buy from the securities dealers, large commercial banks. So no, that should not happen. So great questions, and keep them coming in. Now, for all of those who sent me questions and are watching this, I need your help because I've had several of you ask that I would do a podcast. And since I've never done one, I wasn't sure. And I'm going to ask you, do you want me to take these videos and just convert them to MP3s and put on a site so you can listen to them as a podcast? Or is there some new content you want done as a podcast? So if you just want me to repurpose the audio track and put it on a website that handles podcasts, I just need to know where you want it. And if enough of you are willing to listen to them, can get the word out, I'll continue to do it. If it's new content, then I need to know what it is you're looking for, that I could do it as a podcast, and then I'll see if it's something I can add. So appreciate, an email or a Facebook message or something. Just let me know what it is you meant, and so I can help you. All right, let's get into what we wanted to talk about today, and that is how hedge funds are positioned. We'll take a look at some markets. So we're trying to see the market try to rally off this deeply oversold position. According to the NASDAQ McClellan Summation Index, it looks like the early indications of a potential bottom. Remember, bottoms are generally not a one-time event. They're a 2 to 3 time event, but it's giving us some early indication here. And a lot of this is on the back of pension rebalancing, institutional money managers rebalancing, sovereign wealth funds coming into the picture, computer models not knowing what's going on and trading, chasing because they do, and retail investors thinking the bottom is in. Let's take a look at how hedge funds are positioned. You can go to hedgeopia.com, and sometime on Saturday morning, there's a post, COT peek into the futures through the futures, and what we see is they're still net short the 10-year Treasury bond, which is excellent because we know yields do not bottom until speculators are long. So we're still nowhere near the bottom in yields. That is great news. And with 30 years, they only backed off slightly as yields dipped a little bit. Great news. It tells you that if you're sitting on bonds, not a bottom yet. Don't panic. Don't worry. Wait for these people to realize they're on the wrong side of the fence. As far as crude oil, to all my many friends and clients who work in the oil industry, this is bad news because it tells you speculators are still very long crude oil. And if they unwind these positions by going short, that means they could easily drive crude oil to zero or negative. And that is already bad news where prices are at, only worse news for those who rely on the oil industry for their livelihood. S&P 500, they're still net long a little bit after literally getting hammered repeatedly in this decline. And gold looks like it's up a little bit, but gold is way overextended. This is a massive topping pattern. I expect this to break down at some point when stocks turn over. And they're still long the NASDAQ after getting again throttled in this down move. They're still holding on to their longs. And the Russell 2000, they're moving short as, go figure, the small caps rise a little bit. And last but not least, U.S. dollar. I thought we're at volatility already, but we're not. They're still a little long the dollar. I do expect the dollar to go higher, bounced, as you can see, off overhead resistance, came down. I should have looked today, but maybe we'll take a look. And then they're backing off their volatility futures, which is odd considering they're long the market. I don't understand that, but volatility is up. I suspect volatility will continue to rise. Now let's go and look at some convincing evidence that stock prices have not bottomed yet. So what we're looking at is the Federal Reserve economic data of the money supply measure, or money stock measures. Well, it looks like at institutional money funds. And institutional money funds are simply what you're going to find in your 401k as a cash position, your IRAs, your after-tax account, Roth IRAs. These are all your money market positions, which are effectively 3-month T-bills. And so what you're seeing here is money going in and out of institutional money funds. So the way you can interpret this is people are putting money into money market. How is it getting there? They're probably selling something. So we've seen this rise here. So let's go ahead and overlay the Wilshire 5000. And for those of you who never heard of the Wilshire 5000, it's an total U.S. indice. The only reason I use it instead of the S&P or the Dow is for some reason the Federal Reserve database no longer has the historics of both. So I want to look at the big picture. And what you can see is when the money in money market starts to peak and roll over, you have a perfect matching bottom in the Wilshire, which would match obviously S&P, Dow, and NASDAQ. And look up here, and you can see institutional money funds peaking and rolling over. Boom. So let's interpret this, right? Let's get smarter, because that's why we all listen to this, is where is the money's going into institutional money funds. It's coming out of what? Stock prices. It's going into institutional money funds, coming out of stock prices. Where is it going when it's coming out? Back into stock prices. So now let's look. We've seen since 2018, institutional money funds go up. And finally, the stock market's going down. Now, are we seeing this peak and roll over? It's too early to tell. But odds are no, because if we look back here, what did we say in a previous video? The bottoming patterns in the market are 9 months long. Well, guess what? We could go up in here and we could see, look at how long, look how's the market bottom. Look at what happened. This thing started to peak and plateau. So there's another way to verify what's going on. And so at the moment, you can safely say this is probably not the bottom because there's still money flowing in. Now, how about Treasury yields? Can you use this as an indication there? You can absolutely do that as well. And you can go over here. We'll add 10-year Treasury yields. And we'll put this in. And there it goes. I wish there's a way for it to default to the right sometimes, but it doesn't. And you can see that there's a relationship here. And it's not quite obvious. So let's go in and let's invert the institutional money fund flow, or not flows, but amounts. And voila. So as money is flowing into money markets, it causes yields to go down. Even though these people are not buying bonds directly, money markets are 3-month T-bills. So there you go. So are we at the bottom of yields? No. All right, let's go and look at a couple of charts. So everybody's excited about stocks, and yet we're really no higher than we opened on, the middle of March. So pretty much in last half of the month, stock prices have gone down and gone right back up to where they were. I still suspect that this is not going to hold because, well, it shouldn't. It follows yields. Remember, it's very important. Follows yields. TNX. Oops. And you can see yields are headed lower. So my assumption is stock prices go lower there. But people are pretty excited about it. That's okay. Let's take a look at Treasury yields. It actually closed back up in this low 1.3 range after dipping down to 1.2. I said there was a shelf on 30-year Treasury yields that needed to be broken in overnight trading. And let's look at TLT. And I want to back this up a little bit. And I want to review this Wyckoff chart because there's not a lot of trading stuff that I care for, but I do believe that there's a lot to the Wyckoff trading. I don't know if trading, that's probably not the right word, but he believed there are bottoms and tops and they are created by different patterns. And you can see that as Treasury bond prices fell, they got into this pattern here. And I believe we just hit this last point of support a while back and we're right in here right now. Looks like we're reconfirming this trading range, and once we break out of this top point here, it's off to the races. So now let's look. We went to this consolidation pattern, kind of like a cup. We made a handle, and now we're getting ready to break out. Let's go look at TLT. And let's zoom in a little bit. So here's our cup pattern here. We created a handle on the cup. It broke out. Let's zoom in. Everyone thought bonds were dead again. They weren't. It was just coming down and reconfirming the upper end of this handle pattern here. Bounced up. And I thought at 1.3% on the 30-year, which would this lower dotted purple line. We got through there on Friday. We came up here to around 1.2% on the 30-year, and all of a sudden aggressive selling today. There's still potentially rebalancing being done today and tomorrow that would cause this, but let's zoom in because the last point of support is this price level up here on TLT. You get through that and you're in a huge bull market of bonds. And look, all it did today, we'll zoom in a little bit further here. All it did was come back down right to where the peak was before, where we couldn't break through. So it came back down and it looks like it's trying to reconfirm that. And now we want to see this thing break through the, well, I want to, and my clients do. If you're in stocks, you don't want to see this, but if you're in bonds, you do. It's going to try to break through this upper line. So I added this upper line, and you can see it just goes back to right here in this charting pattern. And what do we see? Sellers here, and sellers here. And now we see sellers over here. So it got up here where people still wanted to sell. So once it breaks through this, you've got not a whole lot left of people to break through. And my guess is at some point up here, some of these people that sold are not new sellers again. They were just, adjusting their portfolio because they had to, taking some profits. But this may be the last line in the sand here. And I think that Wyckoff chart does a great job of predicting where this whole thing was going to go. And let's take a look at the dollar index since we talked about it. And we'll zoom out a little bit more, apparently. And we can see that it's back in this area of support that goes all the way back to 2015. So if the dollar can get through 103, symbol DXY, well, then you're in a massive bull market for the dollar. Again, I don't touch the dollar move or currencies move too quickly. But anyways, we went way longer than we had to because I had a lot of questions from you, and I think they're really great questions. Send me some more. We'll answer them in an upcoming video. Hope this really helped. Again, tell me what you mean by what you want with a podcast, and we'll see if we can deliver for you. Again, I'm Steve Van Metre. Thanks for taking the time to watch. We'll see you on Wednesday with our next update. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.